I'm just saying, are you buying anything at all in the market, or are you of the view that you will get better levels?
Well, I think we just approach it stock by stock, and I think we typically do not sit a lot on cash, as you know. So essentially, we use all kinds of market conditions in order to deploy. Thankfully, we've been on the receiving side as far as flows go, and therefore, to that extent, market, wherever it has been throwing up opportunities, or either it could be growth or value-related opportunities, we are kind of happy to buy it. We are driven more by the individual stock characteristics, perhaps not as much by the overall environment.
Is the market now looking at some valuation comfort in some names, like we saw with, say, Ashok Leyland or Maruti?
Yes, so you know, the broader market, clearly there is a decent value which is emerging in many of the stocks, and that is where we have kind of trained our eyes, and we have been focusing. However, price momentum still continues to favor large caps. Value seems to be gradually emerging in the mid and small cap space, and as we go down the cap curve. So that's basically been the state of the market as far as the more recent past goes. So yes, there is clearly some value which is emerging, but not necessarily in the top names.
I wanted your thoughts on the auto slowdown, because it's not only the OEMs, but you know, there's a snowball effect happening with auto ancillaries, with financiers, and now the latest, we just heard from Sadbhav Infra saying that, you know, at the Maharashtra checkpost, there's a big slowdown in toll revenues because of, you know, slowdown in CV sales, etc. Do you think there's going to be a longer patch of pain across these segments, or do you think now is the time to actually look for opportunities here?
Well, I think as we examine them more and more closely, we find that they are somewhere in the middle. So we are seeing the slowdown still gradually unfolding, and valuations, on the other hand, while stocks have corrected and valuations too have corrected, but they are not at levels where everything seems to have been adequately reflected. Retail trends continue to be reasonably soft, and you know, while and the reduction in inventories, which one has been expecting, has been relatively slow to come by. So it's not at a pace which would have been desired, and therefore primary numbers are likely to continue to, you know, demonstrate more weakness. Our base case assumption earlier, I may have even spoken on this show earlier, that you know, we were expecting things to get a little better during the festive season and beyond. But to me, it looks like it is going to get pushed out even further. And is that all in the prices yet? Is that all which is kind of already reflected in estimates on the street, etc.? I don't really think so. And to that extent, the wait might get a little longer.
Okay. Well, that's not sounding too good, Taher. The expectation from the companies we spoke with, like Mahindra and Maruti, was that the festive season will be a positive. But I mean, they're all hoping, they're all living in hope. Okay, you said that, you know, you are still receiving money from investors. Now, where are you putting it? I mean, as closely as you can hint.
Well, I think if I look at the last 3 months, you know, we've kind of done things in, let's say, sectors like gas utilities, oil marketing companies, a couple of PSU banks. That is where probably some part of the money has gone in. Maybe some few commodity stocks, not as much because we are positive on their commodity price cycles, etc. But just that they appear to be sheer value and you know, seem to be reasonably cheap, even relative to the most pessimistic estimates that we can probably pull out for them. So that is where I think we have kind of done a little bit. We have done a couple of stray ideas, which could probably be in, let's say, something like telecom, or maybe even things like you know, retail, for example. But otherwise, in most of the other sectors, let's say things like automobiles or consumer discretionary, or maybe even FMCG for that matter, and even banks, we have by and large, we've generally rotated. We've essentially swapped ideas from one to another depending upon where we see incremental value. In certain cases, either to be a little more risk averse, or maybe with the intention of booking some profit. So there has been a lot more churn in many of the sectors, and few sectors we have added to new stocks.
Okay, I was going through your India small cap fund, Invesco India small cap fund, and one of your top holdings is DCB Bank. I mean, it's the stock of the day on the downside. Today it's lost 12% because of the weakness in asset quality. You you wouldn't be ruffled here? I mean, would you advise sort of buying on dips and this just being a one-off quarter?
Well, I beyond a particular point, I can't talk about individual stocks, as you know. But yes, as you rightly pointed out, that this is one of our larger holdings. It's obviously not a good day for the stock, given what's come about in the quarterly result last night. We are yet to examine in terms of what's gone wrong. But I think it's generally been a bank which has done reasonably well over a longer period of time. It's been fairly consistent. We need to see whether there's a one-off quarter or something which is a lot more deeper. But beyond a point, I wouldn't be able to comment on individual names, as you would know.
Oh, I know you can't, but you know, both in your Invesco India Small Cap Fund and in the Mid Cap Fund, you have placed the faith in mid cap banks and NBFCs. I'll come to the NBFCs later. But the two mid cap bank results that you have, is that shaking the faith?
No, I can only tell you that we've not really actioned anything after the announcements of these results. So there is obviously no change in the more medium to longer term conviction in these names. But yes, I mean there is obviously an impact, given that they are among our top picks, and the quarter has not turned out to be good. But that happens in a good number of stocks, so that's not something which, be it these or many others. So, you know, we always keep having these one-off kind of quarters for many companies. We go by investment rationale, and I think if that continues to remain valid, then sometimes these sharp corrections sometimes even turn out to be decent opportunities. So we might even do it might even help us in that regard.
Okay, just one final question on a specific stock. I mean, you can generalize it if you want, but RBL Bank is the other one that you have in your mid-cap fund, and there has been this whole exposure to McLeod Russell and the fear regarding that, etc. But I just wanted your thoughts when issues like this crop up. What do you do? Because RBL Bank is a stock that has generated a lot of wealth for investors. Do you ignore it as noise, or do you sort of churn out?
No, you can't ignore it as noise entirely, but we look at it in the context of what is the implication, and what does it mean to the overall bank and its franchise. Is it something which is meaningful, significant, or is it something which is small in terms of size, absorbable in terms of the capacity and the cushion that the bank has, or any other company for that matter, if such a similar issue arises. So we look at it in that context, and if at all the valuation is something which is already reflecting that, then I think we stay patient. If there's a reason to believe that this could get worse and it could have a broader impact or a more longer lasting impact, then we action it accordingly. But it's not entirely, obviously it's not only driven by the reaction or the price reaction which the stock throws up. It's obviously a more balanced decision than that.
Okay, what about IT Pack, Taher? It's done so well over the last two and a half years. But you know, TCS is now at all-time high valuation. Infosys almost getting there. Do you think there's still enough room in IT?
Well, I don't think these are stocks which can do significantly deliver significantly higher returns from here. If return expectations are more in the vicinity of between 10 and 15%, I think they're good for that. That is what we are essentially expecting out of these companies. I think they're getting a little pricier, some of them, especially in a couple of the large cap names, but and valuation differentials are kind of changing by the day. But I think as far as some of the mid-size IT companies go, we think they are still reasonable. In fact, they're getting cheaper. The valuation differential between the large and the mids is widening. Growth is not necessarily getting significantly higher. We obviously are seeing a little bit of, or likely to see a little bit of currency headwind as well. But they are kind of reasonably cheaper. So I think we are sticking around with some of those. In case of large cap ITs, we have backed companies where we have probably seen valuations being a little more cheaper than a couple of others, and that is where we have been focusing a little higher. But even there, the valuations are now catching up. Some of the stocks have done well for us. So yeah, they're there, but they are for that 10 to 15% return expectation, not more than that.
Taher, you know, your one sentence that stayed with me is that you're not expecting the turnaround in consumption in autos in particular in the festive season. It may be pushed out further. that actually makes life difficult for a whole ecosystem of the economy. What is your earnings reading now for Nifty or your universe of companies? Where was it and where are you placing it now?
Well, I think life is difficult on all fronts these days. I mean, on both, even on the fund management side as well as in terms of the businesses. I mean, I don't think we draw up expectations at our end, on a regular basis as far as projections on the Nifty go. But yes, we do look at some of what our own individual estimates for different companies are, and even street estimates on combined basis for the Nifty. But and there, I think some of the expectations are still on the higher side. So I would not want to go by the numbers which are necessarily there in the public domain. We would probably look at, so there are some base effect factors which we are all aware of, which are going to drive Nifty earnings. But beyond that, I don't think the earnings is a lot more better in the broader basket, and therefore to that extent, even there I would like to run with a relatively smaller number in terms of my expectation for FY20 at this stage, unless things materially change from here.